When investing, everyone has an idea of what a successful investor looks like. I feel like it's universally agreed though that Warren Buffett is one of the most successful investors in history, having made the majority of his early fortune through value investing. While most people would automatically jump at the notion of index funds for passive investing, that's not the case if you're someone that wants to maximize your money. You'd have to actively invest and manage your stocks in order to get your money's worth in investing. This is Intelligentsia, real-life advice for practical and financial goals. Today, we want to talk about the methods that you need to implement when using the two-fund portfolio strategy and how it can work for you. So let's get to it. When you think about the stock market, the main thing that you have to understand is that there are different investment styles. What we want to talk about today is value investing. Value investing is when you look for an undervalued stock that has good intrinsic value and you invest in it with hopes of great capital gains the longer you hold on to them. Warren Buffett made his fortune due to several individual stock purchases with companies like Apple, American Express, and Coca-Cola to name a few, and we all know how big those companies turned out to be. So you'd think that for someone that managed to handle his individual and actively managed investments pretty well, you'd expect him to hold on to value stocks and continue investing the way that he does. But on the contrary, in his 2013 letter to Berkshire Hathaway investors, he noted that on his death, he'd want the majority of the trust of his wife's inheritance to be in very low-fee stock index funds and 10% into short-term government bonds. A simple two-fund portfolio. Now, if you're trying to emulate Warren Buffett, this isn't exactly what you want to do off the bat. He didn't build his wealth by playing it safe, but this strategy is safer than having 100% of your wealth purely in stocks. So why does he recommend a two-fund portfolio and why does he value it so much to have it placed there? Well, in your wealth preservation phase, it's always better to have a passively managed fund that mirrors the market and contains investments in bonds for security purposes. When you've built up your wealth, one of the main things to keep in mind is that you want to keep that money for your retirement. You've done doing all the heavy lifting from actively building it, and you want something easily managed and something that keeps itself afloat. Once you have your money and you're set on retiring, defensively investing is what you want. Defensive investors prioritize capital preservation by seeking to minimize the downside risk. They tend to avoid highly volatile and speculative assets, focusing on stable and reliable investments. This is why you'd want stable investments like bonds and passive stocks that mirror the market like index funds. Defensive portfolios typically have a higher allocation to low risk or low volatility assets such as bonds, cash equivalents, and dividend-paying stocks. These assets provide regular income and have historically demonstrated lower price fluctuations. Overall, making sure that you've invested in safer stocks is key to making sure that you have your money kept secure. The reason for this is because you don't have the same time frame for investing, and you'll want to just relax and rely on passive income. Defensive investing for wealth preservation aims to provide stability, regular income, and safeguard the principal investment, making it suitable for those who prioritize financial security and a steady income stream. If you're in your wealth accumulation phase, however, you have to remember that time is on your side and aggressively investing makes the most sense according to Warren Buffett. The primary goal of aggressive investing is capital appreciation over the long term, and with value investing, you'll be maximizing it. By investing in assets with higher growth potential, young investors aim to grow their wealth substantially over time. This is how Warren Buffett did it by buying companies with good intrinsic value, and he bought his stocks for prices that are lower than they are now. An aggressive investment strategy typically involves a higher allocation to equities and potentially other high-risk assets like growth stocks, small-cap stocks, or emerging market securities. These assets have the potential for substantial returns, but come with higher volatility and risk. If we're basing it on his strategy, value investing is the method in which he managed to pick out stocks that made him rich. Generally, young investors have a higher risk tolerance because they have a longer investment horizon before needing the funds for retirement or other major life expenses. With decades ahead, they can withstand market volatility and recover from downturns. In your wealth building phase, market volatility won't matter as much as you need to look at your wealth accumulation in the long run. It took Warren Buffett 7 decades to build his wealth, and while he did make a lot of good choices at first, he also made some bad ones, with one of his investments ending with him losing $3.5 billion. While the two-fund strategy is good for wealth preservation, for value investing strategies, having all your investments in the stock market would be key. A one-fund portfolio would work wonders for those starting out, and expect their investments to grow in the span of decades. If your time horizon allows you to wait it out for that long, then perhaps this one would be the perfect kind of portfolio strategy for you. You'd want this mainly because with time on your side, the market ups and downs won't matter as much. You can invest in bonds when you want security, but the reason why you'd want to invest 100% in stocks when you're young is because that's where your income potential is at its greatest. While the strategy is aggressive, diversification remains important to spread risk. This is why people tend to opt for index funds as opposed to actively manage individual stocks. Young investors should diversify across various industries, geographies, and asset classes to minimize the impact of any single market downturn. Now, value stocks are great, but most people opt for index funds because they mirror the market, and most actively managed stocks don't really beat index funds. While some extremely skilled financial advisors can craft the most intricate and efficient stock portfolio to beat index funds, when it comes to performance, it would take a lot of effort and knowledge in order to do so, and it doesn't always pan out. Buffett recommends the Vanguard S&P 500 ETF for index funds, and for bonds, Vanguard Total Bond Market, with its allocation being 90% in the stock market and 10% in bonds. Investing in index funds is low cost and should be considered for long-term holding. Generally, they only cost you about well under 0.1% to manage, as opposed to actively operated funds that cost up to 1 or 2% onwards. Young investors often choose to reinvest any profits or dividends earned from their investments right back into the portfolio. This compounds their growth potential and leverages the power of compounding over time. Think of it like this. You have your initial investment and you grow it by reinvesting. As a result, you gain more money through dividends or through capital gains because you keep growing the initial investment. These add up when you get to compounding your money over time and can massively impact your returns. You're essentially just saving up your money while making it grow on its own through time. When you compound, all those expense ratios add up, and while you end up making more money through compounding, you have to realize that your expenses catch up with your investments. Aggressive investing in your wealth accumulation phase allows you to explore options in the stock market through different strategies like value investing and index funds. Essentially, what you're looking for while in this phase is to look at the bigger picture and understand that you have a long time to consider investing and making your money as you go. Of course, it's understandable that sudden changes in the market and severe fluctuations can be mentally taxing, but if you look at it over the course of decades, they won't look as big as they do in the short term. Today, we've talked about defensive and aggressive investing, which portfolio types work well for which, and why Warren Buffett's simple two-fund portfolio strategy works for wealth preservation. If you enjoyed this video and found this helpful, please hit the like and subscribe button. We like to be able to grow alongside you and welcome to have you on our next video. Stay mentally healthy and let's get financially fit together.